Welcome back to What the World Wants from India. On the eve of the budget, we are speaking with two big foreign investors in India about their wish list. We just heard it from Wells Fargo. We now have with us Dominic Bokor-Ingram, the Chief Investment Officer and Senior Portfolio Manager at Fiera Capital. And Fiera Capital has over $300 billion of assets under management in various countries. Dominic Ingram, welcome to the show. And thank you very much for joining us. Well, 2019 was a strong year for emerging markets. What's your outlook for this segment in 2020?
My own view comes from a number of different factors. If we look at the technical factors surrounding emerging markets right now, what is clear that currencies are at recent decade-long lows in terms of their valuation versus the US dollar. So the potential for downside currency moves and currency shocks is much, much lower than it has been. If you look at the technical positioning, global funds are more underweight emerging markets than pretty much they've ever been. And in terms of valuation, emerging markets are trading at bigger discounts to developed markets than they probably have in the last 15 years. So the comparative outlook is very good. The question, and the final factor is that 92% of emerging market GDP is currently in easing mode. So the top-down factors look very, very good. Analysts' expectations of earnings growth for 2020 in the corporates is very strong. It always is at the beginning of the year. So I think the key to determining 2020 performance of emerging equity markets is going to be whether the companies can deliver the 15% earnings growth that has been projected. I think if they can, and I think if you have the similar situation in terms of under ownership and continued monetary easing, then 15 to 20% emerging market performance from the equity markets is very possible in 2020.
Then what's your stance on India now? Do you think India can deliver this 15% growth that you are expecting from emerging markets?
Our stance is that the companies that we own in India probably can deliver 15% earnings growth, but the market overall, I think, is going to find it very difficult to do that. Obviously the negatives are the reduction in growth over the last couple of years, partly due to a build-up of debt, and partly due to lower investment levels. So overall, with the current blockages, if you like, to investment and the inefficiencies in some parts of the economy, it's going to make it very difficult for Indian GDP growth to go back up to the 7 or 8% that is required for the market as a whole to grow earnings by 15 to 20%. So, we would be quite pleased if India overall grew sort of in the high single digits in terms of corporate earnings this year, but we can't see the 15% earnings growth coming through overall for the market in India this year.
Okay. Well, in that case, let me come to the big event that's coming up, the budget. What's your expectation from the Indian budget? Do you expect a higher fiscal deficit? What can the government do given its limited capacity? Would you prefer it lowers personal taxes, or would you prefer it increases expenditure?
The main ask goes probably beyond simple monetary or fiscal policy. I mean, starting with monetary policy, it's a very difficult lever to use right now with inflation rising. And we've also seen that with recent monetary policy moves, the pass-through mechanism, because of fears about the stability of some of the banking sector, doesn't really work. So monetary stimulus is very hard. Tax stimulus tends to work on a short-term basis. And you can always create a consumption-led boom by reducing income taxes or by spending taxes, tax dollars in a helicopter money type way. But the only real long-term remedy is for government investment and foreign investment to create long-term benefits to the economy. So there's always a difficult balance when you have a huge democracy like India, of whether you try and stimulate in the short term, make people happier in the short term, in order to set yourself up for the next democratic event, let's say, or whether you take the view that the best thing to do for India right now is to create more incentives for long-term investment. And by that I mean spending the tax dollars by the government on things that are going to generate long-term growth, by focusing on changing some of the institutional factors such as labour law, land law, and changing those factors to create the environment for foreign investors to come in and invest in the economy. Because it is only investment-led growth that will create the environment where the 15 to 20 million new jobs that India requires every year will be created. So I think for too long there's been the focus on what shall we do with monetary or fiscal policy in the short term. And I think it needs a radical rethink of how we create long-term investment incentives, and it's that long-term investment money that will really drive the economy back up to what its growth rates should be at this stage in its development.
Oh, that's such an excellent analysis of India. You are sure a very deep and close watcher of the Indian skies. Let me talk stocks now. You exited Infosys. Are you cautious on the entire infotech sector?
We're not positioned in the IT sector in India. We exited obviously due to some corporate governance concerns, and we haven't found another company that meets our criteria of growth, valuation, and quality in terms of the corporate governance of the business and the protection of the business against competition and reducing margins.
Okay. Well, you're pretty overweight on financials globally. Why did you sell out of HDFC? And any other financials that you like in India?
Yeah, the financials that we like are the private banks like Kotak Mahindra and IDHC, where we think that these banks do not have the legacy NPL issues that are holding back the balance sheet growth in some of the larger state-owned banks. They are only each 9 or 10% of the market, so they're not dominant banks in any way. And even in a lower growth environment, they can continue to grow very strongly by growing their market shares. And they have proven over the last 3 years with their growth rates that the new sectors in India, such as mortgages or consumer finance, the dominant, as I say, state-owned banks in India have not been able to focus on these new growth areas because of addressing the legacy issues, and because they are in many ways capital constrained because of the large NPL and non-performing loans they hold on their books. Whereas some of the newer banks, who are not encumbered by these legacy issues, have both had the expertise to exploit these new areas and the balance sheet flexibility in order to grow their loan books strongly. So that's really where our financial exposure has been most focused in India.
To come back to the macro Indian markets, what will it take for you to go overweight India? What does the government need to do in this budget for you to change your view?
The first thing is that there are parts of India we are bullish on, as in we can find quality growth companies at attractive valuations in parts of the economy, as I have mentioned, whether it's in the container transport business, the ports business, the banks, the TV business. There are very high quality Indian companies that meet our criteria and that we can invest in. I think what is going to open up that universe of potential investor companies to us, investable companies to us, are twofold. One, we need to see real structural reforms rather than short-term fixes in the economy. So we need to see reforms in labour laws. we need to see reforms in land laws. We need to see better functioning of the courts. We need to see more predictability around decisions regarding arbitration. Anything, we need to see a more consistent policy on power, for example, and infrastructure development. If you look at what India is competing with, India is basically competing for foreign investment with the rest of Asia. And countries have gone in and out of providing the ideal investment environment for international companies to come and set up local operations, factories, etc. And it's been very clear that for some time India has lagged way behind in terms of its potential. If you compare it, say, to China in the past, or to Vietnam today, or to Taiwan, Korea in the past. And a large part of that is the way that the institutional framework is set up in India, which makes it hard to execute plans that foreign companies might have. So that's the first thing. And the second thing is we would need to see less optimism in the Indian market. You know, there are quite a few companies in India where we like the quality, we like the management, we like the growth trajectory of the company and the business model, but the valuation is too high. So one of two things has to happen.
All right, we're out of time. Thank you very much, Dominic Bokor-Ingram, for joining us. Both Brian Jacobsen of Wells Fargo AMC and Dominic Bokor-Ingram are asking for deep-seated reforms. They believe that monetary policy cannot deliver anymore, but land, labour and capital will have to be reformed, and the financial sector will have to be set right. That was a big ask from Wells Fargo. Let's see what the budget is able to deliver. Thank you very much for joining us in the special edition of What the World Wants from India.